Okay, thank you for coming. So today's topic is stock splits and its effect on the share prices and the option prices. This is a short session, so maybe 25-30 minutes, and then we will be done. So let's begin this session. So today's topic is the stock splits effect on prices, on share prices, and on option prices. So what happens when the company announces a split? Why they announce the splits? There are various phases of splits. There are various kinds of a split: 2-for-1, 3-for-1, 4-for-1, 3-for-2. There are complicated splits. So what happens if you're trading stocks or buying shares, and what happens when you are trading options? So if you are aware of the effect of stock split, then you are in a better position to trade, so you don't make mistakes. Because committing a mistake in trading is makes a big difference in your bottom line. So one mistake can take out the profit from your 5 trades or 10 trade, even 10 trades. So one small mistake. So you may be profitable, suppose 9 consecutive trades, and then you make a big mistake in one trade just by not knowing something about the stock split, and that mistake can wipe out the profit from your 9 previous trades you worked so hard. So it's very demoralizing. So anything which gives you an edge or make you more knowledgeable, whether it's a stock trading or option trading or anything you're trading, any instrument, is beneficial. So I always try to learn something every day. So this is one of the topics you should know, and it takes only 30 minutes. And if you want to do some more research, you can Google on this topic and do more research and spend as much time as you like. So you may not know this topic, so if you know, it will refresh your concept. So that's another objective. So stock split effect on share and option prices. That's the topic today, and it will last for the 25 to 30 minutes. So the first thing is, what is the stock split? So anything we are trying to understand, we need to understand the core definition of that principle, and then we um, go down further. So if we don't understand the core definition of that principle, or what we are trying to understand, then we are just, when we are studying something, we are just, our mind is just going everywhere. It's confused. So first understand what it is, and then go deeper and deeper into each concept. So you can go deep, 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 deep. So what is a stock split? A stock split is the action a company takes that increases the number of its outstanding shares. So that's it. That is a stock split. That it increases the number of outstanding shares by dividing each share. So um, it increases the number of its outstanding shares by dividing each share. So for example, so in a very simple example, suppose a company has outstanding shares before stock split, 1 million shares. So they have 1 million shares before stock split. And they are trading, the price it's trading at is $70 per share. So simple. 1 million shares outstanding. They have 70 million, the price is $70 per share. And they say, okay, they announce the stock split 2-for-1, which means for every 1 share you hold, they will give you 2 shares. So for every 1 share you hold, they will give you 2 shares. So if you hold 100 shares, after the stock split, you will have 200 shares. So your holding doubles. So that's what happens. So for example, outstanding shares of the company is $2 million after the stock split, because before stock split they had 1 million outstanding shares. After the stock split, 2-for-1, they will have 2 million shares outstanding. But as soon as the market opens, whatever is the price, it cuts into half because of 2-for-1 stock split. So cut into half based on because they announced 2 for 1. So in other words, if you were holding 1 million shares, tomorrow you will be holding 2 million shares. And instead of $70 price per share, you will see stock is trading at $35 per share. So that's the difference. There is nothing happen in the book value. So book value, your investment value remains the same. So you don't gain anything. But psychologically, the stock split works in the favor of the investors. So I will explain you the reason why, and that's why the stock runs up when the company announces the stock split. So this is the basic concept. If they announce 2 for 1, they will have 2 million shares, and the price will be instead of $70, it will be $35. So if you're holding 1 million shares, you'll be holding 2 million shares at $35 per share. Nothing happened to your profit. So why they did do that? So there is a reason. There are many reasons. Two main reasons: the psychology of the investors and the stock's liquidity. So let me explain. If you are holding, imagine if you're holding 1,000 shares at $70 per share, and suddenly you see 2,000 shares in your portfolio, and the price is $35. Even though nothing happened on your profitability, but your psychology, the way the trader psychology works, or the investors, they get boosted, their morale get boosted. They see it as a positive effect. So they buy more. So they buy more, and the reason they buy more of the same stock is because of liquidity. So imagine Amazon trading, suppose at $1,700 or $2,000, where you cannot buy Amazon shares. Not everybody can buy Amazon shares because of their portfolio size. But imagine if the Amazon announces 10 for 1 a stock split, and let's say if it's trading at $2,000, 10 for a stock split. Now it's trading at or 20 for 1. So it's trading. Suppose it starts trading at $100. Now everybody can participate. All the majority of the traders and investors, they can participate in that Amazon stock because it's cheap now. It's $100. They can afford to buy. Their portfolio dictates that they can buy. So even though nothing will happen on the book value on the day of the stock split, but a lot of traders, they will start buying it, or investors, they start buying it. So the stock's price starts to move up. So in other words, if you look at this stock, it had 1 million shares outstanding, and it was trading at $70 per share. So not many, there will be some traders who cannot afford to buy $70 per share based on their portfolio size or their risk appetite. But if it's trading at $35 per share, they can afford to buy $35 stock. So imagine on the day of a stock split, suppose 9:30 a.m. New York time, this stock will trade at 35, and then suddenly it will start trading, suppose at 35.10. It depends on the company, what the future of this company is, what perception the traders have. It will start trading at 35.10, 35.20, 30. Who knows? It can go to 36, 37, or 40. So if you were holding 100 shares at 70, and then you have 200 shares at 35, it's the same value for you. But then you see 200 shares you're holding, and the stock is trading after a few months, trading at $40. So because it was trading at $70 and now it's trading at 35, so the traders or investors, they don't realize that nothing has happened in the background. There's nothing changed in the company's outlook. So they think it's cheap. Oh, $70 per share, now it's $35. So they think like that, and they start buying it. $36, $37, $38. So generally, the rule is that in few years down the road, Some companies even take only 18 months to go back to their pre-split price. So in other words, any move to the upside because of the perception or the psychology of the traders is gain for you if you were holding the shares before the stock split. So a lot of good growth companies, they reach their pre-split price in 18 months. So imagine in 18 months you are doubling your investment in the stock. It can happen. It's not always happen, but it has happened. So it 18 months. So if it drop, if you buy 200 suppose 200 shares at $70, which is 7,000 investment, after 18 months, the you will have 200 shares and it's trading at $70. So your investment of 7,000 become $14,000. So that's the perception of the psychology of the traders and the stock's liquidity. So Apple did it, a lot of companies do it to make it more liquid so that other traders can participate and boost the morale, boost the stock price. Behind the scene, nothing has happened. So there are many kinds of stock splits. So these are there are some odd ones, but these are the most common. And so the most common is 2-for-1 or 4-for-1. So it means if you're holding 100 shares, you will get 200 shares. 4-for-1 means if you're holding 100 shares, you will have 400 shares. And this is simple. 2-for-1, 4-for-1, 10-for-1 is simple. If you're holding 100 shares, 10-for-1 means you will have 1,000 shares. So the mathematics behind is simple for 2-for-1 or 4-for-1. But it starts getting complicated when the odd numbers is involved. So odd number is 3. So 3-for-1, this gets complicated. 3-for-2 is even more complicated. So you need to understand the mathematics behind. So when you are trading, when you have a portfolio, so you can see what happened, why you have what you have. So I'll give you the example. I'll give you 2 examples, 2-for-1 and 3-for-2. So if you understand 2-for-1, you understand 3-for-1, 4-for-1, and then you understand 3-for-2. So you can understand any other combination. So it's a simple mathematics formula. So for trading, it's important that you have some basic knowledge of mathematics, some basic knowledge of statistics. So it's important to know a little bit of math and statistics. So I'll explain later what are those. So there are 6 phases of a stock split. So we need to understand that and what is happening. Later, I'll give you the source of how you can find the stocks which are coming up for a split. So maybe you can have a strategy to make some money. So there are 6 phases of a stock split. So this is the first phase is the pre-announcement phase. So pre-announcement phase means the company has not announced yet. There's a rumor going on. So for instance, there's a rumor going on. Suppose, let's say that Amazon is expecting to do the split. So when you hear the pre-announcement or the rumor, there's no confirmed news. If the company is good and is like Amazon, it will react positively, and the stock starts just based on the rumor that the Amazon is thinking of splitting, or there's someone who is famous, who is well known, and he comes or she comes on TV, CNBC, and they are just arguing back and forth that this company needs to be split into 10 into 1, and this that is very expensive. So they start giving their arguments. So the traders start reacting that this may happen, and the stock will have a positive effect. So it will start moving. So this is the pre-announcement. Sometimes the pre-announcement, the rumor, suppose there's a rumor going on, the company is thinking of splitting, like Amazon, and then it happens. So announcement came. So when the actual announcement came, the rumor became true. In reality, depending on the company, if a company is Amazon, it starts moving up, like sometime aggressively. It will the stock price will shoot up. So suppose it's trading, suppose at 1600 USD, trading at $1,700. So everybody is chasing. So announcement comes. Then so they will announce that on such and such day they will have they will split. So for instance, let's say today is November 18th, and they say that anyone holding Amazon on January 2nd will have this split number of shares. So if they announce, suppose we are doing 10 for 1 split, so anyone who's holding 100 shares will have 1,000 shares on the market open on January 2nd. So, and today is November 18th. So let's say announce tomorrow, November 19th. So what will happen? This is the announcement date. So traders have 1 month and 1 week or 10 days to follow and to buy, because anyone who buys before will and hold on the split date will get that split shares. So there's an initial jerk to the upside, and the buying surges, and then it dies. So maybe you will see effect for a week or 10 days, and then it is gone. Everybody who wanted to buy, they bought it, and then the dormancy period comes where the stock is just moving up, moving down, moving up, moving down. So it's doing nothing. So at this time, you can buy shares for speculative purposes. You can buy calls for speculative purposes, that the company is good, and then the prices are moving, so your call options will move accordingly. And then when there's no action, then you can sell your shares or a calls option. So you made some profit in this period from announcement to dormancy. Then let's say January 2nd, they said that January 2nd is the date of announcement. So it's starting after, let's say, Christmas. So the traders come back on 26, 27. So there is a 1 week period. It's called PreSplit Run. They will, those who want to buy, because January 2nd is the split date. So as long as they buy before January 2nd, they will enjoy they will get the split shares. So they start buying again. So there is a split run, and the stock starts moving again. So there is a positive action, right? So next is the split execution. So on January 2nd, so let's say on before December 31st or December 29, whatever is it, you bought 100 shares, and then you waited. And let's say it's Amazon, and Amazon closed at $2,000, and you bought 100 shares, let's say at $1,900. So at $2,000 Amazon closed, and you bought 100 shares. So on January 2nd, if they announce 10 for 1, so 10 for 1 means for 100 shares, you will have 1,000 shares. So if you bought 100 shares, you will have 1,000 shares. And since Amazon closed at, suppose, 2,000 price, just for example's sake, it will open at, divide by 10, it will open at 200. So imagine Amazon opening from 2,000 to 200, and you have from 100 shares to 1,000 shares. Now you have 1,000 shares, and now the Amazon is trading at 2,000. So it didn't make any difference to you, except the profit you have or the loss you have. Depend if you bought at 1,900 and it's closed at 2,000, or if you bought at 2,100 and it's closed at 2,000. So that's the profit loss. But after the split, there's nothing happened to your own holding. But imagine the psychology of the trader that now Amazon is trading at 200. So the option price is trading at way below prices. A lot of traders, they can buy, a lot of long-term investors, they can buy because their portfolio can afford. So everybody is buying Amazon at because it's trading at 200. So Amazon may go from 200 to 250 to 275 and 300. So 50% run up in short period. So that's what happens. A split execution on the after the split occurs, the stock can go from $200 to $300 in a matter of a month. So because they have seen, the psychology says that they have seen $2,000 price for Amazon or 2,100, and now it's just $200 or 250. So your 100 shares, you have 1,000 shares, and now you invested 1,900 and you bought it 1,900 or 2,000. Now you see Amazon trading at 300. So 1,000 shares at 300 is a big profit. So the next phase, the last phase, is post-split depression. So after the split is happened and everybody is settled, then the stock just goes into the normal mode. So let's say Amazon is split from 2,000 to 200, and then it goes to 250, 275, 300, and then it just becomes normal. Everybody who bought it before or bought it after, so it just becomes normal. But if it's a growth company and Amazon just keeps announcing different things, and profit is going up, suppose, or the loss is not as much as it's supposed to be, then the Amazon will run up again, slow, and then you will see 400, 500, 6,000, maybe in 18 months or 2 years or 3 years or 4 years, you will see back to 2,000 level, and then they will do another split. So your 100 shares goes to 1,000, and from 1,000 they split again. The 1,000 shares can go to 1,500, and then 1,500. So some companies, they just keep splitting, and the stock just keeps moving up. So your 100 shares becomes God knows how many shares you will have at the end. So you just keep holding it. And if they are announcing dividend, then you'll keep getting the dividend. So there's something called stock dividend. So for 100 shares, suppose you get a stock dividend 10%. So 100 shares mean you will have 10 more shares, so 110. So it all adds up, dividend and a split and the company growth and the price. So your portfolio just keeps moving up. So these are the 6 phases of a stock split. So keep an eye on the good companies who announce a stock split. So let me give you some example of the mechanics. So if you understand, the mechanic is simple. So I'm explaining 4 for 1, and then I think I'll explain 2 for 1 and 3 for 2. So let me explain 4 for 1. So let's say this is a real example. It happened on March 21st, 2013, CRM. So the company CRM, they announced the split on March 21st, 2013, and they announced 4 for 1. So if you were trading on 2013, you may remember. So CRM 4 for 1, and they said on March 21st, they said date of split is April 18. So 18 and 9, about 27 days. So 27 days between the date of announcement and date of split. So CRM was already acting bullish before the announcement. So there was a news, or there was a rumor that CRM will announce, so it was acting. And then they announced 4 for 1. So imagine CRM had 400 million shares before stock split. So once the split occurred on April 18th, the 400 million shares became 1.6 billion shares outstanding. So in other words, there were 1.6 billion shares were trading in the market, available to trade and buy and sell. So price on April 17th close for CRM was $170 per share. So price on April 18th, when the market opened, because 4 for 1, so 170 divided by 4 became 42.50. So in other words, nothing happened to your portfolio on CRM if you had, suppose, 100 shares. If you bought on April 17, you bought 100 shares at $170. You invested, let's say, are you seeing my screen or no? Just a second, let me. Okay, you are seeing my screen. So imagine Amazon CRM. Let me see the CRM price right now. So CRM is 132. So 400 million shares were outstanding. It became 1.6 billion. If you bought 100 shares at $170, you invested 17,000, you would have 400 shares and trading at 42.50. So 400 shares you would have at 42.50, and then CRM just continued moving up and up. So if you held it, your money had 300, 400% increase in 5 years. And CRM actually dropped, so it was trading way higher, but just let's say $132. So in other words, you bought at $42.50 and it's trading at $132. So 42 multiplied by 132 divided by 42 is like three times. So your money is 3 times in 5 years. So that's pretty good return. So that's what happened to growth company like CRM. So next example is, so we looked at the effect on share price. So stock split effect on share price, simple share. But what happened on the option? So same stock CRM, same scenario 441. So before stock split, you suppose you had one contract, May 170 calls, and you bought at $8 per contract. So on April 18th, you will see you are holding 4 contracts. So this is what happens on the day of the when the split happens and you wake up. If you are not aware of, let's say, the split, so you will see 4 contracts, and then you will become very happy. Then, oh, did I buy 4 contracts? So why I have 4 contracts? And if you're not paying attention to the number of contracts you have, you're only paying attention to the strike, and you will see, let's say you see the price is $2. So suddenly you think you are losing money. You bought at 8 and now it's trading at 2. So you don't realize that it's 4 for 1. So the price has cut into 4 times. So 8 divided by 4 became 2. So the same contract you're holding is trading at $4, $2, but you have instead of 1 contract, you have 4 contracts, and they also chop the strikes. So the strikes from 170 becomes 42.50. So they they divide the strike also for 4 times. So 170 divided by 4 is become 42.50, just like the share price, 42.50. And instead of 1 contract, you will be holding 4 contracts, and instead of contracts trading at $8, it will be trading at 2. So in other words, nothing happened to your investment. 4 contracts, $2 is still the same as 1 contract at $8. And the strike, you will see, instead of 170, you will see 42.50. So sometimes because of the stock split, the strikes chain are kind of weird. So they have odd numbers like 43.60 or 43.33. So they are called non-standard options, and they are open only till the expiry because they just cannot eliminate the open positions, right? So you have open positions, so they just handle it that way. So if you have May 42.50 calls, then when the May expires, suppose 3rd Friday, then these strikes will just disappear. So they show as a non-standard. So be careful when you're buying options. If you see non-standard, so it means something has happened, something which is not a standard. This is not a standard chain, and then it will expire. So you need to be to make sure that you're looking at non-standard, and you need to make sure that instead of 1 contract, 1 contract, if it's 1 contract of option, if you know 1 contract of option holds 100 shares. So 1 contract of option may be holding different number of shares. Instead of 100 shares, it may be holding 125, or it may be holding 150 shares. So you, if you're not aware of that because of the stock split, you may get caught, and then the assignment and the margin and things like that will happen if you are selling calls or puts. So you have to be aware of So avoid non-standard unless you know what you're doing. So just trade the standard options. So you will see weird strikes. All right. So nothing happened on your book value. And what will happen actually, as the CRM suppose starts moving up after the stock split, because the stock is trading from 170 to 42.50, and then let's say the CRM starts moving from 42.50 to 43.50 to 44.45, you're making money. So you now have 4 contracts. The $2 contract will go to 2.50 to $3. So in other words, you can take advantage if the effect is positive for the stock split. You stand to gain by trading via options. Now, so there was a 4-to-1 example. So this was 4-for-1 example, which is simple because the mechanic is simple. For 100 shares, you will hold 400 shares. So it's simple. But there are some complicated scenarios, and you will see often they for accounting reasons or whatever is their finance department decide that this is the ratio we will announce the split. You need to be aware of the what is the split and what's the mechanics behind. So it's all mathematics. So if you understand the mathematics, it's simple. So let's say this company announces stock split 3-for-2. So if they announce 3-for-2, so it's kind of odd. What it means is for every 2 shares, you will have 3 shares. So that's what it means. For every 2 shares, you will have 3 shares. So let me give you the example. So for every 3 shares, you will have 2 shares, means that for every 200 shares, you will have 300 shares. But if you only have 100 shares, what you will have 150. So it's simple. So but you can do the math. So before a stock split, you own suppose 100 shares, and before a stock split, the price was $60 per share. So you bought 100 shares at $60, and they announced 3-for-2. So you bought it and you invested $60 multiplied by 100. So you invested $6,000. So it's simple. $6,000 you invested, you bought 100 shares. So after stock split, so let's say last day was this Friday, and then on Monday morning, the split occurs 3-for-2. So number of shares calculation. So it's simple. It's easy to do the calculation. If it's like if you bought 200 shares, then you know you will get 300 shares. What if you have bought 209 shares or 10 shares? Then how many shares you will have after the split? So you can do the formula. So number of shares calculation, you divide whatever shares 100 shares, you divide by 2. So for 100 shares divided by 2, you get a denominator, a common number, which will be 50 multiplied by 3, it's 150 shares. So after stock split, you will hold 150 shares. If you bought 100 shares, you divide 2, so divide by 2, 50, then you will get 3. So for 50 multiplied by 3, you will get 150 shares. So what would be the price? The price will not remain $60. If it is $60, then your investment will go up. No, it doesn't happen. Otherwise, all the company will announce is just a stock split and keep increasing their capitalization, so market value. So it's not happen that way, right? So the stock price has to go down. So after stock split, price per share will be, so you will have 150 shares, your investment 6,000, you should expect, so your cost is $40 per share, and this is what you will expect the price after the split. So let's say on Friday, 3:59 New York time, you bought the shares at $60, 100 shares. At 9:30 a.m. Monday morning, when the market opens, you will see 150 shares in your portfolio, and the price should be $40 ideally. It can be $39.50, $39.80. It will open at the price, and then it can go down or it can go up. So if it goes up, you will start making money. But theoretically, your investment will remain same. You will hold, instead of 100 shares, you will hold 150 shares, and the price will be $40. So your investment will still be $6,000. Now, if the stock price goes up from $40 to 41, 42, you will start making money. So that's the concept for stock split. So I gave you the example of 4-4-1 and 3-for-2, and gave you the phases, etc. What are the phases and why they split, and what is stock split. You can find further information on Yahoo Finance. So if you go to Yahoo Finance, this URL is kind of unless you memorize it, is biz.yahoo.com/c/s.html. So just go to Yahoo Finance and then do the search on it, or go to Google and do the stock split, where you can find the better information on the stock split. So you can do that, but it's available on Yahoo Finance. So they list all the dates and who has announced and what's the date and what's the stock split information. And then you can go and do further research and see which one you want to trade. So finally, I have a 90-minute session. I have an 8-month coaching program where I go into details a lot of things, not just this. This is just a basic, what I taught you today. But it's important that you know. So there's an 8-month Mastering the Market coaching program. And if you're interested to find out, we talk for 90 minutes. We'll get together and I'll explain in details. And this session goes for 90 minutes. So you can send me email and ask me about it, and I'll send you the further information. So the email is askus@financialmarketwizard.com. And we have changed the website from Financial Market Wizard to Trade Genie. So rebranding, instead of Financial Market Wizard, now we are Trade Genie. So you can Google Trade Genie and find all the services over there. And there are 9 services. The coaching is not listed there yet. And the next webinar will be on Sunday, 25th, which is right after Thanksgiving. I may not hold it because of Thanksgiving, so please keep an eye on the box. If I don't hold it on Sunday, next Sunday, 25th, then I will hold it sometime in mid-December, before Christmas. And if you have any questions, send me email. I'm always here. And thank you for coming. And have a nice day.